Module 1, Lesson 4, Common Bookkeeping Mistakes and How to Fix Them. Bookkeeping mistakes can happen to anyone, but understanding these errors and learning how to correct them can help businesses avoid financial losses, tax penalties, and poor decision-making. This lesson covers the most common bookkeeping mistakes and provides practical solutions to fix them. 1. Forgetting to record transactions. Mistake: a business makes a sale, pays for an expense, or receives a payment, but forgets to record it in the bookkeeping system. What happens? Financial records become inaccurate, which leads to incorrect income and expense reporting. The business may appear to have less revenue than it actually earned, affecting profit calculations. Missing records can lead to underreported income, which may result in tax penalties. How to fix it? Record transactions immediately, whether using a notebook, spreadsheet, or accounting software. Set up a routine. Allocate time daily or weekly to update financial records. Use bookkeeping software with automation. Tools like QuickBooks, Xero, or Wave can automatically track and categorize transactions. Example: a retail store sells goods for $500 but forgets to record the sale. At the end of the month, its financial statements show lower revenue than it actually earned. This mistake leads to incorrect profit reporting and potential tax filing errors. 2. Mixing business and personal expenses. Mistake: a business owner uses company funds for personal expenses or personal funds for business expenses without proper documentation. What happens? Business records become inaccurate, making it hard to track real business expenses. Tax deductions can become incorrect, leading to problems with tax authorities. Business performance reports become misleading, affecting financial decisions. How to fix it? Use separate bank accounts. Maintain different accounts for business and personal transactions. Get a dedicated business credit card. This helps in tracking business expenses separately. Reimburse personal expenses properly. If a business owner uses personal money for business, they should record it as an owner's contribution or reimbursement. Example: a freelancer uses a business credit card for personal shopping. Later, when reviewing expenses, they struggle to determine which purchases were business-related. This confusion may lead to incorrect financial statements and tax deductions. 3. Not reconciling bank statements. Mistake: the bookkeeper does not compare business financial records with bank statements each month. What happens? Errors go unnoticed. Duplicate charges, missed transactions, or unauthorized withdrawals may not be detected. Cash flow mismanagement. A business might assume it has more funds than it actually does. Fraudulent activities may remain undetected if accounts are not regularly reviewed. How to fix it? Perform bank reconciliations monthly. Compare bank statements with financial records to ensure all transactions match. Use accounting software that integrates with bank accounts for automatic reconciliation. Investigate any differences immediately. If there's a discrepancy, find out if it's a recording mistake, bank error, or fraudulent charge. Example: a company's bookkeeping records show a bank balance of $5,000, but the actual bank statement shows $4,500. Upon reconciliation, they discover a missing recorded transaction and fix the error before financial reports are finalized. 4. Misclassifying transactions. Mistake: a business records transactions in the wrong financial category, such as recording a large equipment purchase as an expense instead of an asset. What happens? Financial reports become misleading, affecting tax calculations and investment decisions. The business might understate or overstate expenses, leading to inaccurate profitability analysis. Tax deductions may be miscalculated, leading to potential audits or penalties. How to fix it? Understand proper bookkeeping classifications. Assets, long-term purchases, e.g. buildings, machinery, equipment. Expenses, costs of daily operations, e.g. rent, salaries, office supplies. Revenue, business income from sales or services. Liabilities, money owed, e.g. loans, accounts payable. Use a chart of accounts. A structured list of all financial categories helps classify transactions correctly. Seek guidance from an accountant or bookkeeper if unsure about classification. Example: a bakery buys a $5,000 oven and records it as an expense instead of an asset. This misclassification makes the business's expenses appear higher than they actually are. affecting profit calculations and tax deductions. 5. Ignoring small expenses. Mistake. A business does not track small purchases, assuming they are too insignificant to matter. What happens? Over time, small expenses add up, affecting profit calculations. Business owners may underestimate operating costs, leading to cash flow issues. Missing records can cause problems during tax filing, as every deductible expense should be recorded. How to fix it? Track every expense, no matter how small. Whether it's a $2 coffee or a $10 office supply, it adds up over time. Use business debit or credit cards. This ensures all transactions are recorded and categorized automatically. Keep receipts and invoices. Store them digitally or physically for easy reference during tax season. Example: a freelancer regularly buys coffee while working from different locations, but never records these purchases. At the end of the year, they miss out on $500 worth of deductible expenses, which could have lowered their taxable income. Why understanding these mistakes matters. Making bookkeeping mistakes can lead to inaccurate financial reports, legal and tax issues, poor cash flow management, misleading business performance analysis. By identifying and fixing these errors early, businesses can maintain accurate records, make informed decisions, and avoid costly penalties. End of Module 1, Lesson 4.